So, a massive new tariff policy was announced, and pretty much everyone agreed on what would happen next. Prices were going to go up a lot. But then, the first numbers started trickling in, and the story they told was, well, not what anyone expected. So, let's dive into the data and really unpack this economic puzzle. And that brings us to the core question, the one everyone was asking. A huge new tariff policy gets enacted. Did it actually cause the inflation surge that everybody predicted? I mean, conventional wisdom was crystal clear on this. Tariffs go up, imports cost more. So you and I pay more at the checkout. Simple, right? But the initial data, it told a completely different story. Yeah, instead of that massive spike everyone was bracing for, just look at these numbers. Inflation, it kind of crept up a little, from 2.3% to 2.7%. And then it just flatlined. It leveled off. I mean, this is hardly the economic earthquake people were forecasting. So, if the tariffs didn't immediately send prices through the roof, what on earth was actually going on behind the scenes? Okay, to get to the bottom of that surprising data, we've got to go back to the beginning. We need to understand the policy itself. And let's be clear, this wasn't just some minor tweak to the trade rules. No, this was a complete top-to-bottom overhaul of the entire framework. And this scale here, it was just immense. We are not talking about small surgical adjustments. This was a 10% base tariff on pretty much everything. And then you had these absolutely staggering rates, like 145% on certain goods from China, and 50% on all steel and aluminum coming into the country. Make no mistake, this was designed to be a major economic shockwave. So that's the big question, right? If the policy was that massive, why didn't prices just explode overnight? Well, the answer is pretty fascinating. It comes down to a really clever defensive strategy that companies used, something analysts are calling the inventory buffer effect. The secret sauce here was all about timing. See, the tariffs were announced, but they had a future start date. That gave businesses a golden window of opportunity. And what did they do? They went on a massive global shopping spree. They started importing enormous quantities of goods before the new taxes kicked in. What this did was create a huge stockpile, a buffer, if you will, of untaxed inventory. And that's what allowed them to keep prices stable for you and me, at least for a little while. And if you want a perfect example of just how far companies went, check this out. This one detail from an anonymous expert report is just incredible. One strategy involved airlifting 600 tons of electronics just to get them into the country before the deadline. I mean, think about that. This wasn't some minor accounting trick. This was a full-blown, massive logistical operation, all designed to get ahead of the policy and put off passing those costs on to us. But here's the thing about a buffer. It can't last forever. It's a temporary fix. And now that those stockpiles are starting to run low, we're finally beginning to see the policy's real ripple effects start to spread across the economy. And, before we even touch on what this means for prices at the store, there's this other fascinating and honestly often overlooked consequence: a massive surge in government revenue. We're talking a record $113 billion collected in just the first 9 months of the fiscal year. And this wasn't some happy accident, it was a direct result of the policy. Some analysts suggest it was even designed in part to help offset other fiscal moves, like recent tax cuts. So, okay, the stockpiles are running low. Now businesses are at a crossroads. They have to make a choice. On one side, you've got major retailers, big box stores, electronic shops. They've already announced they're going to start raising prices. But on the other side, you have these e-commerce and home improvement giants who are saying, nope, we're going to eat the cost. We'll absorb it to stay competitive. This split is really revealing. It shows you the intense real-world pressure these tariffs are finally starting to create. And this whole situation creates this really fascinating tug-of-war at the highest levels of economic policy. You've got pressure from one side to lower interest rates, to stimulate the economy, but then you have the central bank, which has its mandate, keep prices stable, and keep employment high. They've been trying to get inflation down to that magic 2% target. So these tariffs, by pushing prices up, put those two goals in direct conflict. It creates a really serious policy dilemma with no easy answers. Okay, so with the delayed effects of these tariffs now looking like they're about to hit, there's a real chance that prices could start climbing more noticeably. So what does that actually mean for you, for your personal finances? Let's shift gears and explore a potential framework for financial defense in this new environment. All right, so according to financial analysis, when consumer prices are on the rise, certain assets can act as a kind of shield. You've got your historical safe havens, things like precious metals and real estate, which have their own intrinsic value. Then, of course, there are modern assets like certain digital currencies. But here's a really key insight for this specific situation. Remember, this inflation is being driven by the cost of imports. That means companies that actually produce their goods domestically could be uniquely positioned to sidestep these new tariffs. And that makes them a very interesting potential hedge to consider. And if you want to see this principle in action, just take a look at gold. Its price has gone up tenfold in the last 25 years. I mean, the core idea is pretty simple, right? The value of a dollar can be eaten away by inflation, but assets that have a naturally limited supply, like gold, they tend to hold their value much better over the long haul. They can act as a way to store your purchasing power when the cost of everything else is going up. Let's drill down on one of these for a second: rental real estate. It's often pointed to because of its really unique combination of benefits. First, it can give you a steady cash flow. Second, the asset itself can appreciate in value. Third, there are often significant tax advantages, like depreciation. And maybe most importantly for our conversation today, it can be a direct hedge because rents tend to rise right alongside general inflation. So here we are, right back where we started, but now with a completely new perspective. That corporate stockpiling strategy, it was a brilliant short-term move, no question. It delayed the tariff's real impact. But that buffer, it's not infinite. And that leaves us with the single most important question of all. Was that initial calm inflation data just a temporary illusion? Is the real economic storm from all of this still gathering on the horizon?